Welcome to the report. 52% off the Bitcoin supply, I should say, is now in red. It is July 1st, 2026. I think the big question today, this was my takeaway from the report. Do we wait for a final flush here on Bitcoin price, or do we buy now? Mike is attempting to answer that question in today's report. The context is we are, of course, 9 months into the bear market. Bitcoin is still on the week below the 200-week moving average. Some leverage has been flushed. We're not seeing the greed anymore. And the sentiment, in fact, is like kind of sad out there. Apathy market. Attention is elsewhere. And we got to figure out if now is the time to buy, or should we wait for the big one? Should we wait for the big dip? Which of Mike's indicators are flashing by, and which ones are saying, slow down, wait, it might not be the end yet? We'll give the case for accumulating and the case for keeping some of that powder dry. Stick around to the end. This is my favorite part of the report. We get to forecast potential future returns. So the last time people bought Bitcoin in 2018 and the 2022 cycle, when it was here at this price with these KPIs, what did future returns look like? We're going to look at 1 year, 2 years, 3 years, see what the potential rewards might be for all the patience Mike has been advising us to take. Mike, before we get into today's episode, I got to ask you, like the question I asked in the intro, just give me the highest level, gun to your head version, okay? Do we wait for one more flush, or do we buy now?
I think you want to be buying now. So I think, that intro you just put together, I can tell you've been reading the reports, because I think it summarizes my views very well. I think you want to be buying now, and we'll get into why we think, that's the case. Also, if you're trying to maximize the amount of, tokens that you can buy, the amount of Bitcoin you can buy, or your other favorite assets, there's a chance that we could see lower prices sometime later. We'll see. We've been in this 28% or so downtrend since early May. And so I could see the setup here potentially shifting in the other direction. We'll see. But a lot of the work that I've been doing and people that have been following the work is really around just assessing where the risk is at all points of the cycle and sort of aligning the portfolio to where we think that is. So we want to have some risk in play when we're sort of at the top of the market, when we think maybe things are going to roll over. We're sort of at the other end of that now, where we want to be allocated, but we also are trying to keep some cash behind, because as we'll get to in the report, there's still some potential for some more pain out there.
I want to ask you near the end if you're happy, how happy you are with the TDR portfolio construction, what you like and what you might change. But we'll get to that near the end. First, we got to shout out our friends and sponsors over at Galaxy. This one is for the institutions, the institutional capital listening. Whether you are looking at the future of finance, that is crypto, or the next industrial revolution, that's quite obviously AI, Galaxy is the name you need to know. They are a global leader in both of these areas, digital finance, of course, and also AI. On the digital finance, crypto side of things, they do institutional grade trading, custody, and also tokenization services. On the AI side, they have massive data centers, including their Helios site, 1.6 gigawatts of approved power, and they are a publicly traded company, one of crypto's finance. The ticker is GLXY, and you can find out more about them in the show notes. Thank you so much to Galaxy for sponsoring this. Go check out how they help institutions invest, build, and transform relentlessly. All right, Bitcoin price on the week. We were down when I started reading the report, below 59K. We have since popped back up to 60K, but we've been kind of floating in this range, 53% or so from the top. Feels like it's near a cycle low. We are trading below the 200-week moving average. We don't spend a lot of time here during Bitcoin's history. So this is a kind of a key moment, I suppose. The 200-week moving average is 62K, 62.4K. And also, we are down 28% since May 10th, since that time in April and early May when people thought that the bull market was returning. They were not quite correct on the timing. You gave some insights that you thought we were in for a bit more pain, and indeed, we've felt some of that pain. Let's look at the scorecard, okay, you present at the very beginning of today's report. So this is that famous cycle awareness KPI table. We look at the 2018 KPI lows, the 2022 lows from previous cycles, and today. The numbers have changed quite a bit. Tell us what you see when you look at this table.
What I see here is sort of what we were saying at the intro here is like, this tells me like it's a pretty good time to be buying. You know, I think if you focus on maybe the bottom four there, so percentage of supply and profit, 48%. So more than half of the holders out there are experiencing unrealized losses right now. So this is historically a good time to buy. When we look at the long-term holder supply and profit, it's even lower. Again, close to where we got to in the prior bear market lows. When we look at like the sort of 12-month RSI long-term momentum number, that's at 38.9, again, like very much in line with the lows of the last two cycles. And then, as you mentioned, Bitcoin's trading below its 200-week moving average. That's the long-term 4-year moving average that we touched in 2018, did not go below it. We did go significantly below it in 2022, and we've now hit that level, and we've been sort of trading below that for a little bit, and we actually had a monthly close below the 200-week moving average. So that all tells me, like, I think you've got the green light to be allocating, especially on a longer term 1 to 3 year or so time horizon. I think it's a green light. If we look at the sort of top metrics there, those are the ones that maybe look like there could be a little more pain to come. This is where we talk about the realized price for Bitcoin. It's around 54K. We haven't quite got to that level. Historically, we have dropped below the realized price. That's the proxy for sort of the average cost basis of all the coins in the network. So that's one that looks like maybe there's a little pain. The Z-score is just looking at sort of the deviation from historical norms. And again, just looks like maybe there could be a little more pain there. We've talked a lot about the realized cap, which is kind of a way to think about the proxy for the total capital invested in the network. That has just not declined as much as you would expect to see, which is really telling you that there hasn't been enough like capital destroyed, or there hasn't been as much capital destroyed so far about 265 days into this bear market as we saw in the past two. So those are the ones that, look like maybe, we just haven't had enough coin rotation, that type of thing. And, part of what I'm doing when I look at this data and this scorecard is also trying to factor in, like, how is market structure shifting for Bitcoin? We have the ETFs now, 6% of the supply is in those ETFs, which means that like 6% of what we would typically capture in this on-chain data, KPIs, is sort of out of our purview. It's happening in the ETFs. It's sort of like a centralized player where we don't actually get to see the coins, shuffling hands and that type of thing. So we have to factor that in a little bit. And the ETFs are seeing significant pain happening there. We're now down 10% in terms of AUM on the ETFs. So maybe some of, what's not being expressed in these on-chain KPIs, is being captured there. We've also just, on a consistent basis been looking at sort of these cost basis cohorts to try to assess, have enough of the coins rotated hands like that we would typically see. And I would say like the top buyer cohort, we call them, that's the people that bought between 108 and 126K in the last cycle last year. About 50% of those coins have rotated hands. I think that feels like it's pretty healthy in terms of like setting those macro lows. But the cohort below them, we can see that highlighted 16.5% there. That still looks like, there needs to be some more coins rotated. And what we haven't seen, and this is like something I kind of think does have to happen to have more clear confirmation that the lows are in, is like this sort of rapid reshuffling of tokens, which we tend to see at the bear market lows. That's when spot volumes really increase and we just have a ton of activity. I mean, this played out after FTX in the last cycle. And I think you could, if you're anchoring to that, then maybe you need some sort of catalyst to get you there. And maybe we can talk a little bit about like what would those potential catalysts, potentially look like. But I'll pause there and just to get your views. But I think, from my perspective, when you're under the 200-week moving average, the Bitcoin, like you said, Bitcoin does not trade there very often, and historically, that's a pretty good spot to be. So we're tilting the portfolio to be risk on, and then trying to assess whether or not these other risks are strong enough to say let's keep a significant amount of cash back to potentially really buy the lows, really buy that fear later. So anyways, that's kind of the high level of sort of how we're tracking these KPIs.
I think that's a fantastic answer. I guess the thing that still I'm trying to understand, so 4 of the 6 KPIs are screaming that this is a cycle low. Mm-hmm. The holdouts are realized cap and MVRV. Those are kind of the 2 holdouts. Why are they still holding out? Like, in other words, can you help us make sense of these metrics? What has to happen? Do we have to go lower, or does more time just have to, we have to get more weeks and months of this bear under our belt for that to shift into the previous cycle low territory?
Yeah, so I think in terms of like the sort of capital destruction, increase in realized losses that we really haven't seen on par with past cycles so far, I think for that to happen, that's really like we need to see coins rotating hands. And that's the anchor for those metrics to start to come in line with past cycles.
Right. So it's not time, and it's not necessarily price of Bitcoin, right? It's some of that activity, some of that cohort rotation activity that you'd want to see on chain, as we see in kind of the market structure update section.
Yeah.
That shuffling has to happen for MVRV and decline in realized cap to meet the previous cycle lows. And you haven't seen that on chain yet.
We haven't seen it like at a really high level. And I think there's 2 ways you can get there. You can get there like in a sort of more capitulatory event. There's some sort of risk reintroduced in the market, credit event, whatever it is. I'm not sure what it could be, but there's some event like FTX where that plays out, and Bitcoin, actually the price corrects significantly as it plays out. The other way it can play out is, the lows could be in. You could sort of say, well, wait a minute. What if the low is in 58K or so, and we have like maybe another retracement move here? We're down 28% or so from like early May. And this sort of like downtrend is now, almost 2 months into it. So I could see like a mean reversion where we start to trend up. If Bitcoin starts trending up into the mid 60s, upper 60s, we could see some people just lose patience and start to sell their coins, and just things can kind of rotate on their own. I tend to anchor to the idea that like you still need that sort of fear, to kind of really get the coins moving. So the setup to me kind of looks like we're going to see a little retracement here. Could be wrong. Short-term views I've kind of low conviction on. And sort of then the narrative, it starts to shift towards the bottom is in, kind of what we saw earlier in the cycle. And then, we're really kind of looking at like, are we going to be able to get above like the short-term holder cost basis, the 200-day moving average, the metrics that we were looking at back in, March and April when we were experiencing that retracement rally, those will start to come in as sort of upside resistance again. And then we'll see, if there's some catalyst, but it could be a capitulation, or it could just be, the time-based thing, like you mentioned, where people just get impatient, they sell into the rallies, they take their losses and they move on. And that's how we set the low. I tend to think that like it's healthier to get like a real kind of rotation, like a real capitulatory event. And then that really kind of sets the healthy base for the next expansion.
Well, help us recall, we had a capitulation event quite clearly in 2022. That was SBF. That was the capitulation event. But the other data point we have, which is 2018, I don't recall a start capitulation event precisely. It was more kind of that apathy, like exhaustion, like that just months went on, and every rally was just like slapped down by the bears, and we just kind of kept going lower. It was more like that in 2018. So maybe we're a little anchored to 2022 with a capitulation event, expecting Saylor to be the SBF of this cycle. Right. And really it'll happen the way it happened in 2018, which is kind of like this bleed out and exhaustion type thing. But if there is a capitulation type event, let's talk about where that could come from. We've already talked so much about Saylor. We don't need to address that. One thing I was thinking as I was reading the report is like, is it AI? What happens if we see an AI top and that bubble, let's say it's a bubble, I mean, some 20 to 25% sell off on the NASDAQ or something, okay? Like, that can't be good for Bitcoin price. Could that be the capitulation type event of this cycle? Or if not that one, I guess, how do you weight that one? And if not that one, what else do you see that could be on the horizon?
Yeah, I think that's kind of where my attention is shifting. I think you're right that the Sailor stuff, I saw that Strategy put out a framework for how they're going to try to manage, their credit products moving forward. I think they have, it was 2.3 billion or so. I want to say roughly 18 months of cash shored up. And then now they're basically saying, hey, we're setting aside 1.3 billion that we might sell Bitcoin. And so like the market kind of can say, okay, they have enough for the next few years. We'll see. I kind of think that may just sort of kind of go away, especially if Bitcoin price kind of just steadies here. So that's to me less of a risk. I think you're right to say that. And what is the sort of setup here when I look out the next 3-4 months? I think there's like kind of three main risks. This is more like kind of macro stuff. But I think you have the inflation issue that's ongoing, and the market seems to be moving past the war in Iran. We have the latest ceasefire news. Oil prices are down significantly, around $70, not too high from where the war started, which is pretty wild to think about.
It's been surprising to me.
I think that's surprising as well. And my view on that, and this is no skin in the game on this, but it feels to me like that, like the energy markets might actually be in kind of like a secular like bull market that's coming here, and like this is not like just a return to $60-$70 oil. So that'll be interesting to follow. But I think what I'm more focused on is the new Fed president and sort of how they're going to deal with inflation moving forward. It's kind of a tough read because the Fed's new policy is really more about like lack of forward guidance. So the market sort of has to figure this out, which I think is actually a good thing. And what I'm looking at there is kind of the 2-year yield. We've talked about this in the past where the Fed funds rate tends to follow the 2-year yield. That's trading at like 4.2%. So it's kind of out of the kind of Fed funds rate band. And it'll be interesting to see if that sort of stays the anchor.
But that tells us then if that's higher than the FFR, the Fed funds rate, then the Fed funds rate has to go up, right? So that would mean Warsh is moving in the upwards direction?
I think so. I think this is kind of the base case. And the market per the CME Fed Watch, so the market is currently pricing in a 70% chance of a hike in September, in the September meeting. So that's interesting because that's kind of already baked into the cake in some ways. That's pretty strong odds there. And I think the market is starting to come to this acceptance that inflation needs to be dealt with. And this the whole narrative that the new Fed president was going to come in and just crush rates is just not the reality here.
Yeah. Is Trump aware of that?
I don't know if he's being asked about. I did see him make a few comments that he was fine with, when he didn't lower rates in the first meeting. So we'll see if that starts to become an issue similar to how it was with Powell. But I think if you can kind of consider that, okay, the market's really already pricing in one rate hike, what would sort of cause the market the wall of worry to grow further? I think it's that the Fed is actually like really gung-ho about getting inflation back to 2%, which, hard to say again, but I'm starting to think that they may be. And so basically, if you have a situation where one rate hike isn't going to actually get that done, and then the narrative starts turning to, oh, wait a minute, they're dead serious about this. They're going to do as many hikes as it takes. Now the market has to price that. And that's, maybe that causes, equities to sell off a little bit going into, later into Q3, into Q4. So that's one risk, I think, that sits out there.
I will call to mind, that's kind of how the 2000 internet.com bubble ended
right.
was with some rate hikes
Right.
at the top.
Right. And we know, this is kind of like reminiscent a little bit of 2022 when the Fed had to, hike, and we know that was not good for the crypto markets. So that's one thing. I think part of that story, you have the sort of midterms coming in the US. This is just, I think, I don't know if the market is really pricing this as a risk, but it just started to feel to me like we have populism on both sides. It's not going anywhere. And it looks like the pendulum is swinging left to me right now. And so the market may have to start to price in like, a divided government and what that starts to mean for, the Trump administration and their policies, the ability to actually push new laws through starting in next year. And also, potentially just a very combative Congress where, investigations are being opened up into the Trump administration, things are being blocked. And so I think the market will sort of look at that and, okay, that's just political stuff. That's not a big deal. But how that impacts the business environment and, that potentially starting to get priced in, it may not be a big deal for the midterms. And maybe this becomes a bigger issue in 2028 with the next presidential election. But I just feel like there's building risks there. This is where the AI trade, I think, starts to come into this a little bit. Potential regulatory fears, and so we've seen proposals about the government getting involved in ownership of these companies, which historically that is not good for valuations and things like that. So I think just on the political side, like there's some building risks here. So that kind of gets, folded into what the Fed's doing. Now you've got a little bit more of a concoction of like, potentially risk off move. And then the other thing I'm paying attention to is, we talked about Iran and how that's impacting oil prices. And we've seen oil prices come down, or gas prices come down in the US. I don't think that's the case right now in the sort of Asian markets where the supply constraints are much more serious. And this is where, where Japan starts to come into play, where they have a very weak yen right now. And so the USD versus yen is starting to break out. The dollar's rising, yen is weak, even though the BOJ recently hiked rates to 1%, which is the highest level in 3 decades. But you would think that them hiking rates might cause that chart to come down. It's not. The yen is staying very weak. And this sort of gets interesting if this inflation problem and this oil story continues to develop. It looks to me like you have a stagflationary setup in Japan where they're going to have to actually get more aggressive in hiking rates. And then that impacts these carry trades globally, where investors borrow cheaply in yen, take that capital, go into US markets. And so if the rates are coming up in Japan, investors may look at that trade and say, wait a minute, we need to sort of get out of some of that. So that's another thing. Again, all of these things are sort of potentially colliding, I think, coming into Q3, potentially early Q4. And this could be the thing that sort of, brings Bitcoin down with it, but possibly. I have sort of, low to moderate conviction, I would say, on all of this, starting to come together. But I think if I'm looking at and assessing risks, these are the ones that I'm paying most, attention to right now.
And all three of those could be pinpricks, I suppose, that lead to an equity sell-off that fuel a final leg down and final, sell-off of crypto assets that you might want to look for, and that would hit the realized price numbers, let's say. Yeah, the interesting thing was, about populism. You talked about that, and I appreciate that you introduced this chart, which is consumer sentiment over time, over the last 10 years. And it is at all-time lows over the last 10 years. And I've never really gotten a sufficient explanation for this chart of why. I mean, other signals in the economy seem relatively healthy. Why is consumer sentiment at like all-time lows? Like, it wasn't even lower in COVID. And your reason for that is like, well, you could see this in political risk and instability with some of the rise of populism, certainly on the left now, also on the right. And that could be part of the pinprick. Imagine a Gary Gensler style anti-AI government that starts to squash some of the equities gains. That could maybe send us over the edge and do it. Are there any other explanations for consumer sentiment that you've seen that are good? Like, why is it like this? It seems like a mystery.
It's a fascinating topic, I think. That chart, it is actually at all-time lows. I think going back to 1950 or so when this came out. And that chart historically has followed the stock market, right? So there's a total jaws diversion right now where the stock market's all-time highs, consumer sentiment, all-time lows. And yeah, I think you have to sort of look at that, and then you look at the populism and the way things are getting expressed. I sort of view like the populism on both sides as the same thing. Right? It's just people are unhappy with their circumstances, and they're just choosing to sort of they're based on their ideology. They choose the opponent, and to me, it's just something's off. I don't can't really put my finger on it myself. But it's clear that things are off, and the social fabric there's something off in the social fabric. We are seeing this get expressed, in politics. And, I'm not old enough to like kind of go back, and I wish, I talk to older people, hey, have you ever seen this type of like kind of angst, just in the political sphere? And like, most people I talk to say this is different. Like they've never really seen it.
That's because it may not have happened previously, like since the 1930s,
Right. So not that many people that are living today have experienced it. And so it is hard to kind of put your finger on. And yeah, there could be some risk embedded in this that's hard for us to sort of forecast just because nobody's really seen it.
The consumer sentiment numbers mean something. And I think the populist explanation is as good as any that I've heard.
Yeah.
Let's talk about returns. So over the past many weeks of this bear market, one of the repeated phrases you've used is patience. Be patient, okay? Yeah. Let's talk about what the reward for patience can actually be. And you put this fantastic table at the bottom of today's report, Bitcoin supply and profit at 48%. And that's where we are today. So if you had purchased equivalently to where we are today, Bitcoin supply in profit at 48% in the 2018 bear market, the 2020 market where it hit that number, as well as 2022, you could forecast what the returns would have looked like. And if we just put that on today, it's kind of a proxy for if we bought today, what could our returns look like in 1 year, 2 year, and 3 year time slots? So tell us about that. What does it look like from here?
It looks good. I mean, again, this is historical data. Past, performance isn't, necessarily telling you what's going to happen in the future, but I think it's a good anchor. And, we've talked about how like, maybe 60K Bitcoin is kind of like 20K Bitcoin from last cycle. And I think this analysis shows that the returns are really good over, 1 to 3 years. So if you were buying, sort of the end of the cycle, this is November 2018, so it wasn't even the lows. Your 1 year return was 78%, your 2 year return was 367%, and your 3 year was over, 13x. So, that was earlier in Bitcoin's sort of maturity. So those returns are much higher than we would expect them to be going forward. But even in 2020, this was kind of the COVID lows, 10x in a year, when we hit these levels. That came down a little bit over 2-3 years, but still really strong returns. And then, sub 20K Bitcoin last cycle, you were up, as we've talked about, the goal of sort of being patient is, you want to be buying at like a level where the price can this is getting harder as Bitcoin matures. But if you were buying sub 20K, around 20K last cycle, you were up 100% before the market had come to the conclusion that we were in a bull market. So then once that kicks into gear, all the media attention, everything that comes with that, you're just riding a wave. And that's the goal, is to get in at the right prices where you can be comfortably up before the market even really turns. And that's the goal here. And this tells me like you don't need to be too patient. We're below the 200-week moving average. Everything tells me like, you might have to be a little patient in terms of getting those returns. You might have to wait a year, You could go down a little bit in the interim, but from a historical perspective, these are pretty good levels to allocate out.
So if you believe in Bitcoin, Bitcoin is cheap. Historically, Bitcoin is cheap. If you don't believe in Bitcoin, you're probably not listening to the TDR report.
Right.
So it's a cheap time to buy. Let's talk about some key levels here. And maybe I'll just consolidate this by asking you this question. This is more on the downside. If you were to set a single Bitcoin limit order right now at a price point, what would that price point be?
Probably 55K would be one, and then probably a little off of 50K would be another. I tend to actually not use these for the most part, but I think
why don't you? I was curious about that because why don't you use just set some limit orders and just let them ride and what the numbers look like. You seem to be a bit more. You use these numbers, but then it's kind of partially an instinct in terms of when to buy.
It is, yeah. It's definitely more of an instinct and like assessing things as they're playing out, having a plan ahead of time, and then assessing things as they play out. If I'm going to be traveling on the road or something, definitely will use those. But if I know I'm going to be at my desk, it's something where we kind of have a plan in place, and then we're assessing as we go. And so that's kind of, I don't know, it's just, I think investing is very personal, and it's just kind of like, that's just kind of my style. I find that if I just sort of set it and forget it on things, maybe it's a control thing or something. It just feels like a little too distant for me. I need to be in the game. So yeah, it's a personal thing, but nothing against, setting those orders. But yeah, I think in terms of where we're going here, the upside resistance in the near term is, the 200-week moving average. So we had a monthly close below that, which is kind of a significant thing. Like we may now just be in a channel here where we're below the 200-week, and it's kind of hard to figure out where the anchor on the lower end is if we stay in that channel. If we do sort of have a retracement rally, which I think is probably more probable than not here in the near term, then I think we would probably get above the 200-week, and then the upside resistance there is probably like roughly 70K or so, which is the short-term holder cost basis. So we could trade in that range. I could see us trading in that, chopping around during the summer months in that range. The 200-day moving average, which we did hit back in early May, that's now come down to 75K or so. So that's probably like your upper limit. A true market mean is around the same level. But I think that's kind of the setup here. And then we'll see if we have, what that looks like if we do have a retracement rally. Are we seeing sort of impatient investors selling into that? Do we see all the things we were looking at back in March, April? Are we seeing durable spot activity? Are we seeing a shift in sentiment? All the things that would tell me, okay, maybe the lows are in. That's what we'll be looking for. But otherwise, we've been doing these shows and just updating and really following what we consider kind of like this cycle awareness type of work. And a lot of this is, data-driven work that we're comparing to kind of past cycles. And this one has tracked very closely to the past. And so I have a hard time fading that, the lows aren't coming sort of later in the bear market, or roughly 9 months in. Historically, there are greater opportunities, 12 or so months in. And, it's just when you've waited this, when you've been patient and selectively allocating, it would be tough to kind of have an opportunity to buy really cheap Bitcoin and just be out of cash. So I'm trying to keep some behind so that we can buy the lows and just feel really good about kind of where the portfolio is as the market turns. But let's keep in mind that once we hit those lows, it's going to take some time as well to sort of recover and it's not like we're just going to go into a bull market. There tends to be just kind of a recovery period, and, we'll see, we'll be assessing new risks and all that as that comes. But that's kind of how I'm thinking about it right now.
And when we hit the lows, none of you will feel like buying. That's what the lows feel like. You just do not feel like buying in those moments. But Mike, you've been calling it very well this cycle, and all the tools that you've used have led us to a fantastic point here. And basically, I've got to say, over the past months of doing this with you, you've just You've called it very well so far. So the tools you're using must be working. The fundamentals you're assessing are pointing to something. We'll ground folks in this as you put at the end of today's report. In each bear cycle, Bitcoin has established a higher low in terms of max drawdown. So remember these numbers. We went 84% down in 2018, 76% in 2022, 54% so far in 2026. Now, if the ultimate max drawdown, that kind of final capitulation scenario, if that's in line with 2022 and 2018, maybe we see something like a 68% max drawdown to 40K. Don't count on it, but that's possible. And that would be in line with previous sell-offs from the very top. Good time to buy. Also, have a little dry powder for one of these events. There's more in the report, I should say, but I promised to keep this brief with Mike today. He's got to get to the beach. He's got some more insight on portfolio construction for the TDR portfolio, including what he's most happy with, some of the purchases he's most happy with, and some of the things that you would have done differently if you could. So if you want access to that, you have to become a TDR Pro member. The good news is you could do that for free right now. Click a link in the show notes. There is a 1-month trial. You can access this report, see into Mike's portfolio, see what he's thinking about the next months to come, and get insight into that. And then, of course, once you get that free trial, I predict you will become a TDR Pro member, maybe for life. Yeah. We'll leave folks with that. Mike, I
hope so.
Have fun at the beach. Gotta let you guys
maybe
know.
Just one just to add in, Ryan, before we wrap up. So I'm also going to be publishing a report on like kind of the learnings, mistakes. Like I'm going to assess kind of everything that's played out. So we're going to actually publish a report on that so people can have that.
Ooh, special report.
If you're coming in new. And then we have Ethereum, Solana, Hyperliquid. We have a bunch of quarterly reports coming out. So we're doing Ethereum this quarter. A lot of interesting stuff happening with real world assets right now. And we're getting into a lot of that in the quarterly reports for Ethereum and Solana as well. So that's all coming.
Amazing. All right, guys, got to end with this. None of this has been financial advice. This is an investor journal. As you know, we're on the journey alongside you. Until next time, got to stay curious.